$1.26 trillion. That is the upper limit of the capital that could vanish from the American banking system according to research cited by the Bank Policy Institute. This is not a forecast of a stock market correction. It is a projected migration of money from Wall Street into the digital wallets of only a few companies. The mystery is not that the money is moving. Money has always moved in its long history. The mystery is that the person holding the door open for this exit is Donald Trump.
President Trump today signing the landmark Genius Act into law.
All right, that was President Trump signing the Genius Act.
President Trump signed the so-called Genius Act at the White House today and gave remarks.
On July 18, 2025, the president had signed the Genius Act into law. He called it American brilliance at its best. He promised it would make the United States the crypto capital of the world. But there is a catch. The same president who relies on the support of small-town community banks and the huge institutions of American finance has just legalized a competitor that is designed to make those banks obsolete. The Financial Times reports that this has sparked a stablecoin war between Wall Street and Silicon Valley. It is a fight over the financial system of the world. And in this battle, the traditional bank deposit is the primary casualty. To understand the war, you have to understand the system behind it. Most people think a bank is a safe with your name on it. It is not. The Financial Times observes that traditional banks borrow over short timeframes and lend over longer ones. This works perfectly until everyone wants their money back at the same time. We call that a bank run. Stablecoins operate differently, or at least the Genius Act says they must. According to the White House fact sheet, the law requires 100% reserve backing with liquid assets like United States dollars or short-term treasuries. A stablecoin issuer does not lend your money to a homeowner in Ohio. They buy a government bond that matures in 3 months. Pat Toomey, writing in the Financial Times, argues that this makes them inherently safer. He claims that stablecoin issuers take no credit risk, make no loans, and have no maturity mismatch. In his view, a run on a fully backed stablecoin is implausible. If everyone wants their money back, the issuer just sells the treasuries. So if stablecoins are safer, faster, and more efficient, why are the banks terrified? The answer lies in the interest rate. Until the Genius Act, stablecoins were mostly just a way to move money between crypto exchanges, so they were a tool for speculators. But the new law and the lobbying surrounding it is pushing for something far more disruptive. Pat Toomey notes that the Senate Banking Committee is considering legislation to allow stablecoin issuers to pay interest. Think about the incentives. If you can hold a digital dollar that is 100% backed by the government, that moves instantly across the globe, and that pays you 5% interest, why would you ever leave your money in a Citibank checking account that pays you 0.01%? The Bank Policy Institute is quite clear about the consequences. They cite research from an academic named Wang, who finds that any growth in stablecoin adoption will reduce bank deposits and lending. They argue that if stablecoin issuers are granted interest-bearing Federal Reserve master accounts, it would increase deposit flows out of banks, particularly during times of stress. The banks aren't just losing customers, they are losing their raw material. Without deposits, they can't make loans. Without loans, the local car dealership doesn't get a floor plan, and the local bakery doesn't get a new oven. The Financial Times quotes JP Morgan's Jeremy Barnum as saying, "The goal is avoiding the creation of a parallel ecosystem that has all the same economic properties and risks without appropriate regulation." But is it about risk, or is it about the privilege of being the person who gets to hold the money? Tether, the largest player in this space, is already showing what this parallel ecosystem looks like. In their Q4 2025 attestation prepared by the accounting firm BDO, Tether reported net profits exceeding $10 billion for the year. $10 billion. For a company with fewer employees than a medium-sized Starbucks. Tether's CEO Paulo Ardoino claims in the report that USDT has become the most widely adopted monetary social network in the history of humanity. He notes that their exposure to United States treasuries has reached a record $141 billion. Think about that. A private company in the British Virgin Islands is now one of the largest creditors to the United States government. They are buying the debt that funds the American deficit. Stephen Miran, a Federal Reserve governor, has predicted a restructuring of the financial markets. In an article for the Financial Times, Gillian Tett suggested this is American financial imperialism. The article notes that two prominent economists also noted that the growth of stablecoins will reinforce the exorbitant privilege of the dollar. Miran argues that by making it easier for people in emerging markets to hold digital dollars, the United States can advocate against this de-dollarization hype. This is why the Trump administration loves stablecoins. It is a way to weaponize the dollar. If the whole world is using digital dollars issued by American regulated firms, the United States maintains its grip on global finance. As the Financial Times puts it, Trump's team wants to bolster United States' financial hegemony in a world of geo-economic upheaval. But this creates a political paradox. Trump's base is built on two pillars that are now at each other's throats. On one side you have the crypto bros and the Silicon Valley disruptors who see the Genius Act as their declaration of independence. On the other side you have the community bankers and the traditionalist Main Street donors who see their deposit base evaporating. The Financial Times reports that some United States banks are pushing Congress in the opposite direction, lobbying to rewrite the law to block stablecoin holders from being paid interest. And then there are the prosecutors. While the White House celebrates the Genius Act as a triumph of innovation, others see it as a getaway driver's dream. CNN reports that New York Attorney General Letitia James and 4 district attorneys, including Manhattan's Alvin Bragg, sent a letter alleging the law fails to protect victims of fraud. The prosecutors argue that the Genius Act provides an imprimatur of legitimacy while allowing firms to avoid significant regulatory requirements that are needed to combat, for example, money laundering. The CNN article notes a specific, rather cynical point. Prosecutors estimate that in 2024, Circle and Tether each made $1 billion in profits from investing the reserve funds backing stolen and frozen stablecoins. Essentially, they are earning interest on money that belongs to crime victims, while legal hurdles make it difficult to return that money. Hillary Allen, a law professor quoted by CNN, says the Genius Act misses the mundane stuff that has sort of been sorted out for traditional finance through decades of trial and error. She claims the laws were never incompatible with the technology, just with the crypto business model. So we have a president who has signed a law that his own treasury officials likely fear, that his banking donors hate, and that his legal opponents claim is a gift to criminals. Why would he do it? Perhaps because the privilege has shifted. In the old world, the privilege belonged to the banks who held the deposits. In the new world, the privilege belongs to the government that needs someone to buy its never-ending supply of debt. The legendary Martin Wolf is worried. He writes that the United States is embracing stablecoins partly in order to enhance the dominant role of the United States dollar, and so help finance its huge fiscal deficits. He calls it a system that facilitates irresponsible fiscal policy. If the banks are drained of deposits and that money flows into stablecoins, and those stablecoins use every single dollar to buy treasuries, the government has found a perfect circular way to fund itself. It doesn't need the banks to lend to the public, it just needs the stablecoins to lend to the state. It is a brilliant plan. Or it would be, if the banks were willing to go quietly. Goldman Sachs' chief executive David Solomon told the Financial Times that the bank is investing and playing with these technologies. But can you be both the disruptor and the disrupted? The Bank Policy Institute warns that smaller community banks, serving primarily retail and small business customers, may be the hardest hit. If the local bank dies, does the local economy die with it, or is that just the price of American brilliance? The Genius Act has created a world where the government and the crypto titans are more linked than ever, while the traditional financial system is left to wonder what its role is going to be in the future. The question is no longer whether crypto is real. Tether's $10 billion profit proves it is very real. The question is whether the parallel ecosystem can exist without collapsing the one we already have. Martin Wolf argues that we should resist it. He claims the world doesn't need a system that opens the door to criminality and corruption. But the door is already open. The president signed the bill. The treasuries are being bought and the deposits are ready to move. The deposits are ready to move because the math has fundamentally changed. If you're a business owner in an emerging market, struggling with a local currency that loses value faster than a new car off the lot, you no longer need a relationship with a New York bank. You just need an internet connection. As mentioned before, the hope is that the stablecoins end the de-dollarization hype. But what does that mean? It is the fashionable term for the rest of the world trying to find an exit from the American financial system. But the Genius Act has changed the cost of the exit. It has turned the dollar into a digital weapon. This brings us to a concept that keeps central bankers awake at night: the privatization of seigniorage. It is a delightful financial term for the profit a government makes by issuing currency. It is the difference between what it costs to print a $100 bill and what that bill can actually buy. Historically, the government keeps that profit. However, under the Genius Act, that profit is being handed to private companies. Ellen Ray warns in the Financial Times that for the rest of the world, this is equivalent to the privatization of seigniorage by global actors. Companies like Tether and Circle hold the treasuries, they collect the interest and they keep the spread. Isabel Schnabel of the European Central Bank had previously predicted a bond glut, a scenario where excess Western debt raises long-term costs for everyone. But the Financial Times observes that this glut might only apply to everyone except the United States. If every stablecoin issuer is forced by the Genius Act to maintain 100% reserve backing in United States treasuries, the United States has essentially created a mandatory buyer for its own debt. Miran predicts that what he calls a future global stablecoin glut will bolster demand for United States debt on a scale comparable to the Fed's recent quantitative easing programs. He concludes, this could put as much as 40 basis points of downward pressure on United States interest rates. It is a massive subsidy for the American deficit, funded by the rest of the world's desire for a stable digital dollar. This is the Mar-a-Lago dimension. It is not a coincidence. The Financial Times notes that Howard Lutnick, the Commerce Secretary, has well-documented ties to Tether. The Trump administration's embrace of stablecoins is not uncoincidentally linked to these players. We are witnessing a shift in the hierarchy of power. The old alliance was between the White House and the too big to fail banks. The new alliance is between the White House and the too big to freeze crypto issuers. The Genius Act includes a technical directive that is rarely discussed in the marketing materials. According to the White House fact sheet, all stablecoin issuers must possess the technical capability to seize, freeze, or burn payment stablecoins when legally required. The dream of crypto was decentralization, money that no one could touch. The reality of the Genius Act is a centralized kill-switch. The law mandates that these private companies must be able to reach into your digital wallet and make your money disappear if a court says so. It is the ultimate tool of state control, dressed up as innovation. The New York prosecutors, led by Letitia James and Manhattan's Alvin Bragg, argue that even with these burn powers, the system is designed to fail the victims. They claim in their letter to CNN that firms like Circle have chosen to actively thwart law enforcement and to profit from victims' losses. They estimate that Circle had more than $114 million in frozen funds as of last November. Funds that are currently earning interest for the company, not the victims. Even the Bank for International Settlements is skeptical. They note that while regulation can help make stablecoins stable, it does not necessarily make them a replacement for single money. Single money is the economic concept that $1 in your pocket, $1 in your bank, and $1 in a digital wallet should all be exactly the same thing. But if the digital dollar is backed by treasuries and the bank dollar is backed by a 30-year mortgage in a town with a declining population, they are not the same thing. They are different risks dressed in the same costume. The tension in Trump's base is now a structural crack. You have the national security wing of the party, represented by people like Stephen Miran, who see stablecoins as the ultimate tool for dollar dominance. Opposing them are the so-called oligarchs, the established banking elite represented by the Bank Policy Institute. They are not fighting for innovation, they are fighting for their profits. In the short term, the math favors the digital. Standard Chartered predicts that the stablecoin sector will grow to $2 trillion by 2028. Treasury Secretary Scott Bessent projects $3 trillion by 2030. That is a lot of treasuries and a lot of interest. It is hard to argue with Tether's kind of efficiency, even if it is a little questionable. The Financial Times observes that future stock, bond, and fund markets might be tokenized. Even the New York Stock Exchange is launching a tokenized exchange. The big players are already moving in the shadows. The European reaction to this American financial imperialism has shifted from dismissal to defensive positioning. While the United States moves fast and breaks things, Europe is attempting to build a fortress of regulation. Martin Wolf, writing in the Financial Times, argues that Britain and the EU are better off resisting dollar-based digital currencies. He views the current American strategy as a predatory move by the superpower, designed to force the rest of the world to finance its huge fiscal deficits. The mechanism of this resistance is the creation of regulated stablecoins that aim to meet the requirements of transparency and safety. The Bank of England has already introduced a proposed regime for sterling-denominated stablecoins, hoping to capture the efficiency of the technology without surrendering sovereignty to Silicon Valley. But can a better regulated, slower-moving Eurocoin compete with the raw liquidity of the dollar? Elaine Ray warns that the wide adoption of United States dollar stablecoins will lead to lower demand for non-United States government bonds. In this scenario, the world stops buying European or British debt, because they are too busy buying the treasuries that back their digital dollars. This is the asymmetric hook of the Genius Act. It solves a domestic funding problem for the United States Treasury while creating a systemic crisis for traditional banks and foreign governments alike. It is a gamble that the benefits of dollar hegemony outweigh the risks of a parallel banking system that lacks appropriate regulation. But the mundane stuff remains the sticking point. Stablecoins, as Philip Page of the LSE points out, cannot finance our economy because they are not allowed to lend to anyone. They are a cash instrument. If the deposits that use to fund mortgages and small business loans are locked away in a digital vault to buy government debt, the real economy might find itself starved of credit. The Trump administration's bet is that the efficiency gains will somehow offset the loss of traditional lending. They are betting on American brilliance to solve a problem that has historically ended in bank runs and financial panics. It is a bold and perhaps reckless experiment. What do you think of stablecoins? Share your thoughts in the comments below. If you enjoyed this video, please subscribe and check out this analysis of Intel's $100 billion bet on the future. Thank you for watching.